Hello and welcome back to our video for today. I am Willie and I'll bring you through today's topic, which is looking at margin in a more specific way in order to help you in your trading. So sit back, grab your pen and paper ready. Let's dive in right now. Now, what actually is margin? Is it something that can be eaten or is it margarine? Nope. Actually, margin is one of the most important aspects in Forex. However, I would say that quite a lot of people actually ignored margin is because it might be a little difficult to understand how it works and it will also involve some calculation. But I would say that margin is actually quite important as it actually determines how healthy your account is during your trading. So for today, we are going to go through margin in a rather specific way to learn what it actually is about. And we were going to look at a few examples that may help you in your trading itself. So first, we're going to look at what exactly is a margin. Margin is actually defined as a sum of money that will be required to stored or deposited with the broker, but for temporarily to open or to keep a position afloat. Now, this whole sentence might be a bit confusing for some of us. So we're going to dial down to two sections here. So first of all, a margin is actually a sum of money, a small sum, I would say, that will be kept at one side that cannot be used. It is kept there for safekeeping, or I would say goodwill, in order for you to open a new position. So every time you open an order, regardless of how many lots that you order of your order is, or how big it is, there will be a sum of money that will be kept at one side, untouched, that cannot be used for certain length of time until you close the position itself. So this is margin in terms of opening new position. And at the same time, before your position is being closed, it will still be retained at that point of time. And it will only be reimbursed, or I would say refunded back to you, the amount of money that had been kept at one side once you close the order or it is being automatically closed. So margin is like being safe kept by the broker for you to keep this position open or for you to open a new position. Since we know how margin works, but how do we actually determine how much margin that is going to be set aside when we open a new position or to keep it afloat? This is where we know about margin requirement. Margin requirement is denominated in percentage. It is the percentage of margin that will be required to set aside to open a new position and keep it afloat. Now, margin requirement normally is being indicated in the MetaTrader 4, whereby you can check for each margin percentage by right-clicking on the instrument, click on specification, and scroll down to look at margin requirement. So for example, right here, today I am going to do a trade on USDJPY, and when I check on MT4 or MetaTrader 4, the margin requirement is at 2%. And today I was feeling a bit hawkish. I'm going to buy 100,000 worth of USDJPY. So how much margin that I will require to set aside? So we're going to take the value of 100,000 US dollar. We're going to times it with 2%, and thus we will get 2,000. So this is actually the amount of margin that will be required to set aside to open this position and keeping it afloat. Now let's say I have earned quite some money with this trade, so I'm just going to close it. So whenever I close this trade itself, the 2,000 US dollar is going to be refunded into my account. So this is margin and margin requirement. Since we know a little bit about margin requirement, now we're going to look at use margin. Now, use margin is going to be quite simple. It is basically the sum of margin for all the trades that you have right now that is currently floating. Floating in the sense whereby the trade is still currently running in your account. Maybe might incur profit or loss and you still have not closed it yet. So it actually totals up the sum of margin that is being incurred for all these floating orders. Now, the calculation is pretty simple. All we need to do is to sum up the margin that has been incurred for each trade, and there you have it, use margin. So right here we have this example whereby I have opened 3 positions: EUR USD, GBP USD, and USD JPY. And the margin that's being incurred for each is being listed here. Euro USD will be 200, Pound USD will be 150, and then USD to Japanese yen will be 100. So basically, to count the use margin, we just need to sum up everything here that is being incurred, which is 200 plus 150 and 100. We are going to get the answer of 450 use margin. Now, since we know what is use margin, whereby it actually calculates how much margin is being incurred, there will be the opposite called free margin. Free margin is literally the sum of funds, or known as equity, that is available to open new positions. It is actually quite simple to calculate this. So we're going to look at this example right here. From our previous example for use margin, we have calculated that all 3 orders that has incurred margin, the total of use margin is around 450 US dollar. Right now, the equity on my account is 1,000 US dollar. So how do we calculate free margin? Basically, we just need to take our equity and then we're going to minus it with 450 and we will get $550 of free margin. What does this mean is that I have 550 US dollar left to open a new position and keep it afloat. Now, since we have learned the basics of margin, we're going to take a deeper dive and look at the more specific terms for margin, which is margin level. Margin level is actually expressed as the percentage value whereby the equity is divided by use margin, and then we're going to times with 100%. Now, Willie, I don't really understand what this means. That is where I'm going to explain even deeper. First of all, margin level, we have to understand its concept. The first part of the concept is to understand its formula. The formula is quite simple, whereby we just need to take equity and divide it by use margin. After we get a sum here, we're going to times with 100%. Margin level is always denominated in percentage form. Now, the second implication of margin level is that it actually helps you to gauge the status or the sort of health of your account. Why do I say that? It's because as margin level goes higher, this will also means that you have more free margin. And when you have more free margin, this will also mean that you could open even more new position. And indirectly, when you have more free margin, it will also explains that your account is at a healthy state to sustain any losses from your floating positions. So this is margin level. However, how do we actually apply what is margin level into Forex and also this formula? So now we're going to take a look on our previous example. So we have an equity of 1,000 US dollar and we have 3 orders so far, and each order has incurred its margin. And from the use margin formula, we can calculate the total is 450 US dollar that has been incurred. Now we're going to take the margin level formula, which is equity divided by use margin, and then we're going to times it with 100%. So we're going to take 1,000 US dollar here, divide by 450 US dollar. After we get the answer for this, we're going to times with 100%, and we're going to get a total of 222% of margin level. So let's ask ourselves, is 222% of margin level healthy or not? From what I would say is that anything above 100% is considered healthy. However, as you inch closer towards 100% threshold, I would call this as threshold, you are actually inching closer to the danger zone. I will explain why later on, as you can see from subsequent examples that I'm going to show, why inching towards 100% may be a alert or a wake-up call for you to save your account. Next, we're going to look at margin call. Margin call is a scenario whereby the broker will send you a notification stating that your account margin level has fallen below the safe threshold level. Now, this notification will be sent to you either via SMS or MT4 or even email. In this notification itself, they will also encourage you to deposit more funds into your account so that you can actually avoid having further losses thereafter. And this further losses that we're going to talk about is known as stop out. Stop out, we're going to explain even further after this. Now, the predetermined margin call threshold or the safe threshold level that we explained earlier is also known as margin call level. Now, each broker has their own margin call level and it is being disclosed in their official website. So please make sure to check them out whenever you want to invest with a broker itself. So how do we actually compare our margin level with the margin call level? Now we're going to take a look at this example here. For example, right now we are going to take a look into equity first. Equity is around 1,000 US dollar, and because I was a bit reckless in opening all my positions, I have used up 1,200 of margin. And for this broker that I'm trading, the margin call level is determined at 90%. Now, the first step to actually compare with margin call level is to calculate my account's margin level. How do we do this is to take 1,000 US dollar of equity. We're going to divide it with 1,200 US dollar of used margin times with 100%, and our margin level right now is 83.33%. Now, since my account's margin level has fallen below this safe threshold, I will receive a margin call. And this is where the margin call is being triggered. Notification has been sent to me to urge me to deposit more funds, or I might succumb to even more losses thereafter. Now, last but not least is stop out. Stop out is a scenario whereby all of your orders is being closed automatically. And this scenario actually happens after you ignore a margin call. This scenario actually occurs more often than you think it is, and here are the two reasons why. Number one, failure to deposit after margin call. There may be a few elements or factors that may come into this, but sometimes a margin call may be triggered when we are sleeping, and due to that, we may miss out on the notification itself. And when the market is moving quite fast and you stumble upon further losses thereafter, stop out will be triggered. Second, high volatility in the market. Sometimes the market may react to certain news with rapid movement. If the account could not able to sustain such big movement in a small time frame with such huge losses, then you may trigger stop out straight away without even experiencing a margin call notification. So this is something that you need to look into, whereby plan your trade ahead, minimize your risk, and make sure that you have enough funds in your account before you start trading. Now that's all on margin and how it will save you and your account. If you'd like to know more about similar topics, don't forget to subscribe to our channel. I'll see you guys soon.